Hello.
How you doing, Tom? Can you hear me?
Yeah, can you hear me okay?
Yes, I can, buddy. How you doing?
Yeah, I'm good, thanks. Yourself?
Yeah, not too bad. Just ticking along and trying to annoy as many people as I can. But apart from that, once a bit of time. Shall we go for it?
Yeah, absolutely.
Great stuff. Let's do this. I think we are now live. Good morning, good evening, good afternoon, wherever you are. Thank you very much for joining us. Xavier, you would need to raise your hand and then I can bring you up. So thank you very much for joining us, everyone. This is Startup Fundraising Q&A. We run this every Thursday from 12 to 1 p.m. UK time, where we seek to help startups like yourselves with whatever questions you may have on fundraising to take your business to the next stage. Whether you want to know when's the right time to start fundraising, who should you try and fundraise from, whether you should try and get a angel on board or perhaps a VC, or maybe you want to know how to get your pitch deck done and perhaps how to deal with valuations and various other things. All you have to do is join us here for our startup fundraising Q&A 121, and then introduce yourself, fire away with whatever question you have, and my panel will do their best to try and help you. The idea is quite simple. Unfortunately, over 90% of startups fail. And the top three reasons for that are one, market fit, two, running out of money, and three, not having the right people. So when it comes to that second reason, in terms of running out of money, I guess we're not all rich and we don't have rich aunties and uncles to leave us money either. So you would need to go somewhere. Now, this is the place to be if that is your situation. For those of you that are tuning in via YouTube or Facebook, please be aware that unfortunately we're unable to monitor your questions there. So you would need to join us here on LinkedIn. You can either go to our website, startuptoscaleup.club, and click on today's event, which is Startup Fundraising Q&A 121. Or you can join us live here on LinkedIn. So just hop onto LinkedIn, search for Startup to Scale Up Club, and the last post there, it's today's events. By the way, we also run a few other events. So we currently run 4 per week. Monday's talent, Tuesday's product and tech, Wednesday's growth, and obviously, as you can see today, it's fundraising, and they're all from 12 to 1 p.m. UK time. We're going to start with some quick introductions and then open it for questions from the audience. We'd appreciate it if you don't leave it for too late for questions, because then we'll run out of time. So without further ado, my name is 𝗦𝘁𝗿 I'm an Albanian in London, helping startups as a talent partner, also doing some growth advisory, and lately been helping a few angels and family offices with their due diligence and assessment. I've got two brilliant experts in the field, both of them sporting a blue shirt on their LinkedIn profiles. We'll start with Tommy and then Xavier, please.
Thanks, Anton. My name's Tommy Breen, and I'm a senior advisor at a company called The Growth Stage. So we are a capital raising platform that connects, as our name, very on the nose name gives away, connect growth stage businesses with typically equity capital. So we're working with businesses that are usually looking to raise their sort of Series B or C round later, right up to much bigger pre-IPO rounds. So numerical terms are kind of supporting businesses when they're looking to raise maybe $15 to $20 million, right up to in the hundreds of millions of dollars in some cases. And then outside of that, I'm also a mentor at Founder Institute, so doing a lot of work supporting earlier stage founders.
Hi, I'm Xavier Ballester. Thanks, Anton. Yeah, I'm a director of an angel investment network. So we've been going for 20 years now. We wanted to democratize access to angel investors. So we have platforms where Entrepreneurs can register, put forward a pitch, and then on those platforms, we've also attracted quite a lot of angel investors over the years. We've got 40 of those covering 90 countries. I work on our broking team, so that's been going for about 10 years, and we work with just a couple of companies every week, usually at seed stage, so normally raising maybe something between 300,000-400,000 up to a couple of million, so pre-VC stage companies. We're totally sector agnostic. They usually have got a little bit of traction in the market, more often than not in the form of revenue. And yeah, that's us.
Well, that's brilliant. Thank you very much to both of you, gentlemen. Thank you for joining us today. I guess we've got Mohammed on stage, so we can go to Mohammed and then see who else wants to join us. Mohammed, thank you for joining us. Please feel free to introduce yourself and then fire away with whatever questions you've got for us today.
Sure. Hello, everyone. My name is Mohammed 𝗙𝗂𝗶𝘀𝗶𝗀𝗶. I work on infrastructure and use cases, decentralized use cases. And basically, I'd like to ask regarding the tools to raise funds that, like the panels or the platforms you guys just introduced, is it to a specific network, or is it a place where we can list our equity then anybody can buy, or is it just going to be advertised to a specific people? And the other question is, what do you think about DAO, the decentralized autonomous organization, as a way of raising funds? Thank you.
Mohammed, I'll be honest with you, I'm not sure I fully understood the first question about the tools. Would you mind just going through it again? I'm sorry, buddy.
So, sure. Basically, I tried navigating through platforms where I can, because I'm in a stage where I need to raise funds, and where it's very critical, and a lot of people are interested to buy equity directly, but I couldn't find any platform where you can just have an equity and people can directly buy the equity without cutting a lot of portion to the platform.
I see.
There are some ways of Uniswap if you are listing a token, but that's a utility. But I couldn't find any platform to provide equity selling. Is there, or maybe I'm not aware of any.
Are we talking here like a crowdfunding sort of thing, or do you know what a crowdfunding is?
Private sale, probably. Yeah.
Okay, I hear.
Yeah.
I think I've come across, I'm just trying to remember now, I think I've come across a couple of platforms who claim to kind of basically help people crowdfund without going to a crowdfunding platform, if that makes sense. So a bit like a direct sale like that you're saying. For the life of me, I can't remember what they are. But to be honest with you, I don't see why you would want to do that when you can just go to a crowdfunding campaign. They have all the tools, they have all the kind of legalities covered, everything. They may take us a cut, but I definitely think it's worth it. I don't know if Tommy and Xavier want to add anything there, but that would be my view.
I don't mind. Would you mind mention any of those platforms or campaigns?
I mean, you've got Crowdcube, and I don't know. I don't want to start Republic. I think Crowdcube has joined Republic, and a few others. Maybe Xavier and Tommy will list a few.
Sure.
Yeah, I think just on your second question, the DAO stuff, I don't know a lot about it. I've not been involved in anything with DAO, so unfortunately I can't really offer you any insights there. In terms of what we do at the growth stage, how we operate is we onboard companies that are looking to raise on the basis that we meet the management team, the founders, go through the business with them and make sure it's a business that we'd have a good chance of getting them at least some traction with institutional investors, if not necessarily raising it. If we don't believe the business is something we could work with or help, we just won't onboard them because we don't want to waste their time or our time. And then typically the way it works is on the growth stage, the company has a profile on there and they can upload their pitch deck and all those types of things and bullet points and as much information as they want. All the investors in our platform, they sign an NDA as part of their onboarding. So there's no need for separate NDAs if they want to give access to a deal room. And essentially there's a traffic light system. So if an investor logs in, they'll be able to filter the companies by type. So whether it's fintech or B2B SaaS, look at who's, green, actively raising, orange is gearing up and getting ready to raise soon, red is not actively raising, and they can engage directly then with the companies through the platform to set up meetings. But also in the background, we do kind of quasi broke a bit. So we will, when we bring on a deal, we will reach out to the investors we think will be interested to let them know and try and facilitate conversations. But in terms of the transactions, we are, a licensed broker, but we choose not to handle client money. So we don't take the investment. That happens directly like a normal, venture capital raise between investor and company. But, it's not like a trading platform where you can just say you're, trying to sell equity and it can just be bought through the platform. It's still the way venture capital works. So the investors will go through their due diligence process and issue a term sheet and all those types of things. So there's, nothing different in that regard. And, as Anton said, it's not really, you don't really want your equity to be tradable because you kind of lose control over the valuation of your company. So as soon as there's secondary transactions happening in the business, you're losing control. So, there's lots of businesses out there that are trying to improve and build a more active secondary market. But for companies and investors, there's a lot of things that need to be worked out there. So there are platforms. So there's another platform called Flow that I know of, FLOWW, I think it is. And they're backed by the London Stock Exchange. So the London Stock Exchange is their biggest investor. I've not actually had any interaction or engagement with the platform, so I can't tell you, what the quality is like, but I know they do primary and are trying to do secondary transactions on there. And then there's another one called Odin, so ODIN, doing similar stuff. And those are the only other two I can think of right now, but they might be worth checking out. But, from your point of view, if you do want to use one of these platforms, you just want to run it like a traditional venture round and just use that as hopefully an access point to more investors. So you'd be saying, look, we're, valuing ourselves at X, Y, and Z, looking to raise, this amount of equity and your pitch deck and all that kind of stuff, but you wouldn't really want to have sort of active secondary equity trading on there.
Yeah.
Thank you, Tommy. And by the way, Mohammed, I've just posted in the comments of the group of the event today a list of top 10 crowdfunding platforms in New Zealand. You might want to have a look at. And yes, Tommy, you're right. Flow and Odin, I think they're the main ones at the moment. Xavier, any thoughts on this, buddy?
Yeah, I'm afraid I also don't know anything about the DAO, so sorry about that. Yeah, once you're a big company and you've IPO'd and you're on the stock market, and there's shares that could just be bought like that. But with startups, it's a different beast, and the money is tied in for quite a while until there's an exit. So it's the whole equity raises of going through things like crowdfunding, or looking for angel investors, or it's different. Early stage investment, there's not just really readily available to just buy and sell shares and offer equity to investors. So yeah, I'm afraid you have to go if it is a startup you have on your hands, you have to go the traditional route, which is like all entrepreneurs, go to events and speak to as many as possible about how they've done it, because you'll find that it's a fraternity. Entrepreneurs are always ready to help each other.
Just out of interest, sorry, Mohammed, like what amount of capital you're trying to raise and what size is the business? I actually just kind of assumed it was early stage, but I'm not sure if you mentioned.
Yeah, actually, it's very early stage. It's an infrastructure for Web3, basically. And it is very technical, the infrastructure itself. However, now I am building use cases using that infrastructure. So I can interact with customers directly with those use cases, or with specific niche problem, and solve it with that use case. And I have developed some prototypes and almost MVPs as well. And I partnered with some people who really interested on using the platform for their own construction projects as well. However, I need not much. Like I know how to hire people in a very low price way. Like I always outsource, and a lot of things I do myself. At some stage, I would need to hire the right people. So maybe a couple of hundred or 100K, something around that. Even 10K would help me at this stage where I am. Like I want to I can get things run under 10K or under 100K. But basically, I'm planning to have like users trying the use cases and see where it is basically solving a main pain, and then adding more features and value to the use case.
And you've know in your immediate friends and family network anyway to kind of rustle up 10 grand now.
I've already like resourced that. I've already
Okay.
invested lots, like more than 50K I've already invested.
Yeah, okay. So I'd say, try and do, as Xavier touched on, try and network and engage, and if there is much of a local ecosystem of other entrepreneurs that have maybe had some success already and can afford to write, 10, 25 grand checks into earlier stage businesses. And then the other thing I think about is also any of your potential customers. If, I don't know what price you're going to be selling this infrastructure at, but, would they be able to potentially write you a check to help build this product for them if they think it's really good? So using the prototype you have, you can kind of get close to a sale and demonstrate that it'd be something really useful and something they would want if you can build it. There are cases where businesses that really want a product will invest cash or pay cash up front for the product so you can go away and build it. So it's not easy doing that, but it does happen. Like, it is possible. And there's actually a book called Crossing the Chasms worth reading if you haven't. They talk a bit about it in there. And so that is one other avenue, but like, it's not easy to do that. But if you're struggling elsewhere, if you've got interested potential customers in a prototype, maybe you can have the conversation.
Yeah.
Thank you very much, Tommy. And Mohammed, if I may ask you, in order to
Sure.
get it for somebody to use what you want to build, how much
Yeah.
are you going to need? I'm not talking about something that has all the bells and whistles, something that just basically does what it says on the tin kind of thing. How much are you going to need?
Around $1 million.
Okay. And you can't do it with less than that, basically.
Well, I could, if I could, like, basically invest on not on the infrastructure, on the use cases, as it would derive like a revenue instead of to get it ready. Yeah.
If you don't have a working prototype, how can you derive revenue from something?
What I'm saying is that like a MVP, like an actual product.
So that's what I mean. An actual MVP that will
functional use case, not just prototype. Yeah. And which we're gonna market. We have one now called My IP Space. You can look it up, myipspace.com. That's a use case. And we have another use case which I partnered with a developer, construction developer. It's called SLQ.co.nz.
The reason why I'm saying that, Mohammed, is that at this stage, there are only 3 things in general where you could go. Number one, I really, really keep, and I think I've mentioned this to you before, but I really think you should look at the accelerator route. Number 2, it's obviously, as the gentleman here have mentioned, the angel route. And number 3, it's the corporate VC. So you go to a company, I don't know, let's say a big construction firm or a big construction and building sort of materials firm or something around that. And you say, this is what I'm working on. Would you like to invest or somehow work together or whatever that case? but you need to really, really niche it down, and you need to make a list of people that you can contact. It doesn't matter that you're based in New Zealand, because what you're working on could be used elsewhere. The only thing is, in my experience anyway, that normally people like to invest in jurisdictions they know and they're aware of. So yes, it's a good idea to start in New Zealand, but then you can spread out there. And you literally need to sit down and make a list of, I don't know, hundreds of people you need to reach out to. Can I ask you, are you doing another job at the moment? Are you earning a living?
No, I'm doing this full time.
Okay. Reason why I'm saying that is that if you are working on your own, it can be quite tough. But if you have some kind of money to maybe find like a virtual assistant, I don't know, I'm just for argument. In I don't know, Philippines or in
I usually have Lebanon.
Whatever it may be. Pardon?
In Lebanon, like I used to have stuff in Lebanon, which is very affordable, like $500 a month. Yeah.
There you go. So if you can find somebody like that will help you, so you can guide her or him, they help you in doing that research in terms of bringing that list to where it needs to be, and then they make the initial contact in terms of how you advise them and guide them to do it, and you just hit the ground running, because you can't keep going around in circles. That would be my advice, my friend.
Yeah.
Alistair, did you want to add anything, Xavier?
I mean, I wanted what I was thinking is, if you are looking for these kind of early stage funds and you've got through friends and family, if you have developed a product that is, I mean, if you've got, I don't know, the plan for it and only you can do it, and you want to find some external money, then you should be registered for SCIS, because if you are going to find some money, it is obviously.
He's based in New Zealand, Xavier.
Oh, he's in New Zealand.
Yeah, because I have no idea what's SCIS.
Apologies, I thought you were based in New Zealand.
No worries. It's a UK scheme, but I wouldn't be surprised if New Zealand hasn't got. Sorry, I would be surprised if New Zealand didn't have something similar. So SCIS in the UK, Mohammed, it's a scheme for tax. Sorry, go on.
So here's a question, if you don't mind me asking. So if I could find an investor in UK, for example, would I just register an entity there, or I would make him invest here on this entity in New Zealand?
There are two ways in order to get, for example, this SCIS scheme, which basically is a tax incentive. Then yes, you would need to set up in the UK. But because you are based in New Zealand, and if you don't want to set up in the UK and you find an investor here, I don't think that would be too difficult, because New Zealand does have a sort of good legal framework that a lot of Brits can understand and trust. So I don't think it would be an absolute must, although it depends on the investors.
Oh yeah, sounds perfect. Thank you very much, guys, for all the information. Looking forward.
You're welcome, Mohammed, and best of luck with what you're working on. Please do feel free to join us again. Now, a quick reset of the room. This is Startup Fundraising Q&A. It's our 121st session. We've been doing these for over 3 years now. We've had over 260,000 people join us, and we've moved from Clubhouse to LinkedIn. I think now we need all the help we can get to spread the words and let other people know that we're here. So if you are finding any value in this, please do feel free to share it and tag people you know and so on. Now, if you are tuning in via YouTube or Facebook right now, please be aware that we're unable to monitor your questions there. So you would need to join us live here on LinkedIn. You can do that either going to our website, startuptoscaleup.club, and look for today's session, Startup Fundraising Q&A 121, or you can just jump onto LinkedIn and search for Startup to Scale and the last post, it's today's event. We're here to help founders with whatever questions you may have in terms of fundraising to get your business to the next stage. There are no right or wrong questions, and there's no need to be shy. We've got two brilliant experts on stage with us today, and they're going to be here for the next 35 minutes. Now, if your questions, however, are not on fundraising, then please save them for the other events we run. Monday's talent, Tuesday's product and tech, Wednesday's growth, and Thursdays, as you can see today. And they're all from 12 to 1 p.m. UK time. And you can actually RSVP to any future sessions via startuptoscaleup.club. Now, just before we go on to some questions, I didn't get a chance to ask Tommy and Xavier, what would you say are your biggest do's and don'ts, gentlemen, when it comes to early stage fundraising? And don't worry about repeating stuff that you've mentioned in the past. So shall we start with Xavier this time and then Tommy, please?
Sure, I guess I'd say it every time of just being investor ready. When you're going out for investment, don't be slapdash. Be ready with all the documents that you're going to need if they want to do due diligence. Make sure you check everything that goes out. Ask other entrepreneurs to look at your deck. Look at as many decks as you can. Don't leave errors. You need to give an impression of capability, and investors want to know that they're putting their money in capable hands. And that doesn't mean just being a genius and coming up with great ideas. It also is putting them into action and delivering and executing. And by the way you present yourself, you also give investors an insight into how capable and how well you're going to be able to execute. Try and give that feeling off as much as possible. Be transparent with them. Don't try and hide anything, because if they do due diligence, they're going to find things out and then it looks even worse. So yeah, just be ready with the overall package of stuff you need. There's lots of websites. We've got advice on ours about things that you put in your data room, for instance, different sizes of deck, whether you need a business plan, all these kind of things you need to address, because once you start going out there, if investors are asking you for things and you don't have them to hand, then it doesn't look good. You can't be going and scrabbling around for things during your raise, because you're keeping them waiting, and that means that they're not going to be that impressed.
Thank you very much, Xavier. By the way, both of you, if you don't mind having a look at the messages, I've sent one of the questions that was sent in to us, and maybe we can go through a few of those. What about you, Tommy? What are your biggest do's and don'ts?
I'd say to take a step back from before you even get to the stage, as Xavier's talking about. Although I guess if you're raising at all, you need to have your deck. But trying to understand, is your business venture backable? I think there's a lot of entrepreneurs out there, and they start a business, they feel part of the journey they're supposed to go on is to go and raise capital and raise venture capital particularly. And that's not always the case. And you really need to understand the type of business that you are starting. And is it one that is venture backable? And people ask, what does that mean? It means, does your business have in a market that is going to give the business the opportunity to become truly massive? So, talk about unicorns all the time. Can it be a $1 billion business? Now, the very early stage, at seed and even a pre-seed funds, which there aren't tons of, but there are pre-seed funds, they are kind of looking for that, but maybe doesn't have to get to $1 billion, but it needs to certainly have the possibility to be worth hundreds of billions for those investors to be able to see a worthwhile investment that they can actually get a substantial return. And your business may not be venture backable. That doesn't mean it's not a good business and that you can't, turn it into a very successful, profitable business that can earn you millions. But, whilst a business that might one day be worth 10 or 20 million is a huge, unbelievable return for an individual, for the funds, that's not what they're looking for. So before you waste your time going out to investors who will never reply to you or never invest, and it does take a lot of time to raise capital, you really need to analyze your business, understand what investors are looking for, and does your business really have that opportunity? And sometimes when you're in the early stages of business, you have these great ideas, but it's difficult, to be honest, to say, actually, could this business really be worth hundreds of millions or, even billions one day? Sometimes you have to take a step back and think, is that really what this is? So I'd say, to just understand, is your business venture backable, and do some reading and further research on that before you waste your time going out. Even if you decide, maybe your business isn't venture backable, there are still angels that will invest in businesses, because if they're going to invest at a valuation of, you know, 500,000, or some cases even less, actually, if that business does get to be worth 10, 20 million, that's a huge return for them. So, it may not be necessarily venture backable, but you may be able to get some early stage funding from angels still that will back an early stage business to get it going, if there's a quicker path to profitability and you won't need a lot more money beyond that. So, take time to really dig into that before you start going out and, sending a deck around to loads of people who might never look at it. So, take your time and do your homework on that.
Thank you very much for that, gentlemen. Whilst we're waiting for some people to come up with questions live, I've sent in our group chat, the panelist chat, a question that came through to us. So this is Cybertech founders in Bristol. They're at seed stage. It's 2 IT security specialists and a nurse. And then he goes on to say, we've built a cybersecurity platform specifically for healthcare providers. The challenge is that healthcare is a highly regulated industry, which makes investors nervous about potential delays. How do we navigate these concerns whilst emphasizing that the need for cybersecurity in healthcare is urgent and growing? And what regulatory milestones should we showcase? Oh boy. Tommy, do you want to go first on this, and then Xavier?
Yeah, I'd say, like, on this point, there are a lot of funds out there that are investing very actively in healthcare, health tech, and all that space, and they are, you know, pretty up to speed on the hurdles these businesses face, and they build that into their risk models when investing. Like, they build in these delays, and if something gets delayed, then more capital will be needed, and so they're pretty up to speed in these. So I would say, if you're getting a lot of investors that are very worried about this, maybe you're speaking to investors that haven't done a lot of health tech before, or healthcare, and that's going to be a difficult hurdle to overcome generally. You can do some research on businesses that have been successful that face delays, but any investor that's not comfortable, doesn't understand healthcare, it's going to be difficult to get them on board, because by the nature of it, even if it's cybersecurity rather than an actual medical product, it's still, the NHS moves slowly, everything moves slowly. It's incredibly difficult to even get a trial in the NHS for anything. So it is difficult, and delays lead to businesses potentially running out of money, which means raising more money. So I would say you need to I'd say it's maybe a reframing of the investors you're speaking to, and thinking, how can you get in front of investors, whether it be angels or early stage funds that have actively invested in health tech before, because that's really who you want to speak to, because they'll understand these delays, and they'll be able to do a risk assessment themselves and whether they believe it's something they want to do. But yeah, I'd say, like, it's going to be difficult trying to educate or explain how delays can be overcome, or these things, to investors that don't do health tech. Like, a B2B SaaS investor that's never done health tech is going to struggle, whilst they've maybe done cybersecurity before. They've never done cybersecurity into the NHS, and it'd just be, they'd have to go and do a lot of homework to become, more of an expert in healthcare. So I would actually just say, you need to think about the investors you're speaking to and try and find other investors. So I know Xavier might be able to give you a bit more than I will on actually specifically angels and how you approach them, or find health tech and experienced health tech investors and angels. I think there is actually the Cambridge Angels is probably one. Like, I'm guessing, being based in Cambridge, they do a lot in that space. So maybe trying to approach someone like that is pretty useful. But yeah, pass over to Xavier. He might have more to give.
Good point. Thank you, Tommy. Xavier?
So with these kind of highly regulated industries, what I would suggest is advisors approaching people, because obviously it gives you a lot of legitimacy in terms of your investors, that you've got somebody advising you that is on the inside, that knows about these delays, and that can potentially either open doors or anticipate where certain delays are coming, so that you can feed that into your plan. So I would start with that, because it just gives you that legitimacy. I think that you'll also just, I mean, having those kind of knowledge in the business has to be good anyway. And then also, if you can get letters of intent, that an advisor such as this might be able to help as well, that you do have, I mean, there's committees and things that they have to go through, and obviously, it does take a long time. It's a slow moving big beast, but if you can get secure letters of intent, that can also help investors feel more comfortable, because it's showing that they will get there, and that just patience is required. So those were the couple of things that I felt might help.
Thank you very much, both of you gentlemen. My 2 pence on this is, if you haven't already done so, have a look at Innovate UK, reach out to NHS Innovation, and also SVRI Healthcare. And on top of that, you also need to look at university college hospitals. These 3 are definitely worth looking into. There's also a new government campaign by the health secretary, something I can't remember the name, but basically they've come up with a website where they want to hear from innovators and people in general that know the field in terms of what can be done to help the NHS. These are things I would definitely advise you to look at. Secondly, both the gentlemen here have mentioned the angels, so I would definitely look at that. And actually, I would perhaps go a little bit further. If you can gain access to a database like 𝗏𝗏 or something along those lines, and literally just have a look for angels that have invested in the last 2 to 3 years in health tech companies. You can find those details and just reach out to them via LinkedIn, email, Twitter, however you can get through to them. Make a long list and literally just hammer the phone, or however you're able to get through, because that will take you quite a long way. So that would be my advice. Rightio, we now have 22 minutes to go, so a quick reset of the conversation. This is our Startup Fundraising Q&A. It's our 121st session. We've been doing these for over 3 years, almost 4 years now. And the idea is that we're here to help founders with whatever questions you may have in terms of taking your business to the next stage and funding it for whatever needs you may have. Those questions on fundraising can be on anything from, I don't know, let's say your pitch deck, to your due diligence, to your data room, to valuations, to maybe investor outreach, and how do you decide whether you should go to an angel or an accelerator or a bank or a crowdfunding platform, and all that jazz. There are no right or wrong questions, and there's no need to be shy. It's a learning curve for us all. If you're tuning in via YouTube or Facebook, please be aware that unfortunately we're not able to monitor your questions there, so you would need to join us live here on LinkedIn. I can already see, for example, on YouTube, there's quite a few people there. So don't be shy, just come and join us here on LinkedIn. You can do that either via startuptoscaleup.club and look for today's session, which is Startup Fundraising Q&A 121, or you can go onto LinkedIn and search for Startup to Scale Up Club, and literally the last post there, it's today's event, and you just click on that and join us through that. By the way, if your questions today are not on fundraising, please save them for the other rooms we run. On Mondays, it's talent, Tuesdays, product and tech, Wednesdays, growth, and Thursdays, fundraising. And they're all from 12 to 1 p.m. UK time. And you can RSVP to any of them via startuptoscaleup.club. By the way, if you're finding any value in this, please feel free to tag any founders you think may need this kind of guidance, or perhaps just share it with your network. Now, I've sent another question, gentlemen, to our group. Where was it? I think this was the AI. Yeah. So this is from two AI founders, two data graduates based in Birmingham. They're pre-seed. And then they go on to explain, we're preparing for our first CVC, so corporate venture capital. So corporate venture capital meeting with a large corporate that's interested in our AI-driven analytics platform. What are the key differences between pitching to a CVC versus a traditional VC? And how should we tailor our pitch to highlight the strategic synergies that would benefit the corporate investor? Oh dear. Right. Well, in terms of those differences, I don't think you should care much about that because you're going to see a corporate investor. So forget that. In terms of pitching the synergies, maybe that's where Tommy and Xavier might want to focus most, but I'll leave it up to them. So I'll let them go first. Do you want to start with this one, Xavier, and then we go to Tommy?
Yeah, I mean, it seems just like a question of making sure that you pitch yourself as being as complementary to what the corporate, the company behind this corporate VC is doing. Try and make yourself seem as complementary. That's what they're here to do. They're going to invest in you, and then it often leads to a trade sale further down the line. So it's just a traditional VC pitch or deck or something like that is you're focusing on what you're doing and let's say what your market is, etc. But here you've got to tailor it a little bit just to say, well, how are we going to help you target your market or whatever it is that this corporate is trying to do? So as much homework as you can do on that corporate, and then tailor to your deck to show, well, look, with our technology, we will be able to do this for you, this for you, this for you, and almost make it sound like there's no way you're going to be able to do it yourself without the help of proper experts like us. Often corporates can't move as nimbly as startups, and that's what they're often buying into. They're investing in a company that can move swiftly and adapt itself to new problems that come up all the time. So maybe even anticipate some of the potential problems that this corporate might be having. They might be making people aware of that, and then see whether you can't help them fix those and think not only about the present but the future of the corporation that is backing the VC that is interested in investing in you.
Thank you very much, Xavier. Tommy, any thoughts on this?
Yeah, I guess this is one of these ones where, it would be helpful if they were here to ask it rather than send it in. But, it really depends what outcome they want from this business ultimately. Like, are they happy to, build this business and maybe get potentially acquired by this corporate further down the line and some sort of, acqui-hire or something like this? Or are they trying to like build a proper business themselves and this will just be one customer? Because you're probably going to go in with two different, pitches to that. If you're looking to be eventually acquired by this company, then you're probably going to, tailor your approach to make it look, like that you're going to build a product that's particularly amazing specifically to them, and you can tailor things and, all of that. Or if you're trying to build a bigger business, you don't want to pigeonhole yourself like that with an investor at this stage where they're going to be annoyed in a few months when they're not the sole focus of what you're doing. And you don't want to try and win them as an investor by, kind of lying or misleading them, because that's just going to cause you all sorts of headaches and problems down the line. So it really just depends what outcome you're looking for from this, how you tailor it. But, I think you want to say to them that, we're building this, we believe we can offer your business this, and actually we think, some of the technical expertise and access to your, customers and suppliers could help us really, develop this into something much bigger, and try and, lay out how you could help them, but how you feel resources beyond cash that they can offer you will also really help this business grow exponentially and build something amazing that in turn will be really good for them. I would say whatever your long-term approach is here, whether you're trying to build, a really big business and want to like keep running it for a long time, or if you do want to sell, if they are going to invest, I would get other investors involved that are solely focused on financial returns. So, the corporate venture capital arms typically aren't solely focused on financial returns. But if you don't have somebody in there sitting on the board as well that is looking for a financial return, you're going to get led down, a path. And, it's very obvious if you're trying to build a bigger business yourself and you don't want to be bought out by this business, where that becomes problematic. But also, if you do want to be bought by this corporate at some stage, if that is your focus here when you with what you're building, you still want outside investors, because what will happen in the meantime is the corporate will probably try and steer this to, not turn the business into financially very expensive business that they're going to have to buy out. So you want somebody on there that's going to be looking for a big financial return on their investment to actually help whatever happens, even if it is an acquisition from this company, that it's going to be at a good valuation for you. So I would also encourage you to get, if the CVC is the leader of the round, still get some follow-on investors and try and have another board seat if they're getting one, to actually try and counteract that as well.
Thank you very much, Tom. And yes, I totally agree with that. You need to be aware of what the aim is here. One, on your side, i.e., are you happy for them to literally just acqui-hire you, or maybe use whatever IP you have, or if you want to kind of go the long run? That's number one. And two, what are their aims on this? The bottom line is, without having you here, is you want to basically convince the CVC that their market, their clients will be better off with your product or service. It's as simple as that. And as a result, they would be making a ton of money, either because you sell it off and you get an exit, or because what you offer, it's so good that their current clients and new ones will want to get on board. So basically, it's working on that money side of things. So you've got to show them that what you have is going to give them a return, whether it's via equity return or a return in terms of profit. That's number one. The second part, again, not having you here and knowing what your plan is, I would definitely speak to a lawyer. If you are lucky enough for them to want to proceed, speak to a lawyer, because it can be quite tricky sometimes in certain conditions that CVCs put, etc. And then, because I've seen cases where VCs then simply do not want to touch a startup that has got some funny terms with a corporate. So maybe that's something you need to look at. And I know I'm jumping the gun here, but if you are lucky enough to reach that point, definitely don't go at it alone. Now, we've got 11 minutes to go, and this is Startup Fundraising Q&A 121. We're here to help startups with whatever questions you may have on fundraising in order to take your business to the next stage. If you've got any such questions, don't be shy. There are no right or wrong questions. All you need to do is raise your hand. We'll bring you up on stage, you introduce yourself, and then fire away with whatever questions you have for us. If you're tuning in via YouTube or Facebook, please be aware that unfortunately we're unable to monitor your questions there. Therefore, you would need to join us live here on LinkedIn Live Audio. You can do that by either going to our website, startuptoscaleup.club, or and look for today's session, which is Startup Fundraising Q&A 121, or you can go onto LinkedIn and just search for Startup to Scale Up Club, and the last post there is today's event. If, however, your questions today are not on fundraising, please save them for the other events we run. Monday's talent, Tuesday's product and tech, Wednesday's growth, and Thursday's fundraising. And they're all from 12 to 1 p.m. UK time. And you can RSVP to any of them via our website, startuptoscaleup.club. Now, if we haven't got any live questions, I've sent another question in our group chat, gentlemen, if you would like to have a look at it. This is a health tech founder in Poole. They're at seed stage and a medical graduate founder. Then goes on to say, we're negotiating equity terms with a VC principal who wants to pull in with a few others as angels instead. That's right. How do I structure the equity agreement to protect founder control whilst allowing enough flexibility for future fundraising rounds? What are the most common equity pitfalls that early founders should avoid when bringing on their first investor? This seems a bit strange, but the only thing I can think of here, and I've sort of heard of such cases, not many, but I've heard of a couple of cases before where VCs thought that the startup was way too early, and they wouldn't be able to kind of honor their mandate. So they went the other kind of journey basically, and they said, okay, we'll pull in a few people, put in some money, and then if things go well, you can come back to our fund and hopefully we can help you there. I'd like to hear what Tommy and Xavier got to say on this. Let's start with Tommy and then Xavier. What's your view on this, Tommy?
Yeah, this one I want to be careful on just not being able to ask more questions because it definitely kind of looks strange. So, as you said there, Anton, it's not unusual for people that work in venture capital funds to do angel investing outside. Typically businesses, as you said, that are too early stage or maybe aren't really the focus of the fund, but they like. But it is kind of weird when they're asking questions about founder control. I worry here are these investors, this angel investment pool asking for, a pretty abnormal amount of equity. If you're worried about control, like if this is early stage, you shouldn't really be giving up more than, I don't know, because if it's not going to be an institutional round, I mean, I'm not sure you really want to be giving up even 20% at this stage, but without knowing what stage it is, how much you're raising, and being able to ask a few more questions about why the fund aren't investing, it seems strange, but it would seem unusual that like a principal at a VC fund would be trying to ask for an abnormal amount of equity or excessive equity, and I just wonder, it sounds a bit strange to me basically. So I don't really want to give advice on it and or give too much thought on it unless the people that ask the question can maybe come and join us next week live and get a bit more information on it. But I mean, on the face of it, it definitely sounds a bit strange to me, I think.
Yeah, speak to a bleeding lawyer. Xavier.
Yeah, speak to a lawyer, and I think there's not going to be any preference shares because presumably if it's a UK business, it will qualify for S or EIS. So all the shares will be, they have the same status. So yeah, just don't give too much of the business away at this stage because you will need to raise more, and then once you've given away more than 50% of your business, then you effectively have lost total control. So don't give too much away at this stage basically. Make sure the valuation is correct, check out talk to other people about how much they've given away, those kind of valuations. But yeah, early doors, don't give too much away.
Thank you very much. And I can't remember all the details, but I saw 𝗦𝘁𝗿 interviewing Revolut's founder, and one of the things that really resonated in terms of this question anyway, one of the best things he said he'd ever done for Revolut is to not have investors on the boards, but instead to have operators, people who had experience in that. Now, it's easier said than done, because not many people can afford to do that, in the sense that, you know, you haven't got the ammunition, simple as that, and you need the money, and only certain people are able to do so. But yeah, my advice, just same as Tommy and Xavier, don't give out too much equity. And, you know, if they're asking to be on board and on the board and so on, maybe try and find a way to have them as advisory instead of having board rights. But again, it's easier said than done, and not having you here makes it even more difficult. So please feel free to join us live next time if this hasn't been helpful. Now let's quickly go to Colleen. Quick introduction, quick question, please.
Good morning, everyone. It's Colleen from Canada, CEO of Save Planet Refillery. We're transforming distribution with new infrastructure and technology to remove packaging. I think as a startup, you're always trying to, what am I not telling them? What am I not? So you go down many channels in order to show the value of what your business is doing. So bringing in a new channel, such as now the government is interested. So I've presented to a city, indicating to them that if you purchase a system for your transportation hub, for your school divisions and your correctional institutes, the government can now save money and create a revenue they've never had before. So there is interest now from new US cities now for looking at a different form of distribution. So how do you create, you know, this playbook that I've created now on all the interest that I've generated? How do you get the investors to finally go, I really want in? And there is no urgency when the world is in crisis environmentally. For some reason, finance sees zero urgency. I don't understand the logic. Please help.
Yeah. Thank you very much. So how do you get investors to say, I want in what you're working? I'll give you my quick 2 pence and then pass it on to Tommy and Xavier. You want to be able to convince them that they will have return on investment on a period of time between 2 to 10 years. It depends where you are. And you need to convince them with data and traction and perhaps background of the team. It's simple as that. Tommy?
Yeah, I think, you know, if you're talking to investors that only have purely financial ambitions and they're not really that worried or, you know, not concerned with the environment, then, you know, that's not going to be anything that's going to create urgency. So I wouldn't spend too much time focusing on it. I would focus on the commercial aspect and just, you know, giving updates, you know, typically quarterly, but if you're trying to raise actively, maybe if there's interested parties, maybe monthly, you know, saying we've got now interest from, you know, this government or this state body, and, you know, also start maybe creating a scoring system like most salespeople do in your pipeline, like, you know, how far along it is. So whether it's a numbered scoring system or, you know, you're calling stuff hot, cold, lukewarm, whatever, and trying to be clear about, you know, how close you think these governments or states are to actually transacting, to actually, you know, paying you for something, and what the timelines are, how long you think it'll be. So trying to show on a, you know, monthly basis that you're really building significant traction and building up your pipeline and stuff is getting closer to closing. And then if some of the investors you're speaking to do have, you know, sustainability targets as well, well, then you do want to bring that in and show those KPIs and what actually the product can do once it's being actively used by governments or states, whoever it is. So, you know, it's really about laying out the KPIs and trying to show, you know, the traction, not just the conversations, but at what level those conversations are at. But I think that's really the only advice I can give on it.
Thank you, Tommy. Xavier?
I mean, you might be able to sidestep having to have that many investors if you can find appropriate grants. I don't know if you've gone down that route, but it sounds like your business is proper impact business. So it could be that for the early setting up of it, or you know, setting up in specific areas of the states, maybe that they have grants in place. I know that over here in the UK, there are grant businesses that will look at your business and say, well, we think we can get you this, this, and this, and they'll do the process for you. They will charge a commission on what is found, but it could be that something like that, or going on an accelerator or incubator that focuses on impact, will be able to tie in with certain government grants or give you access to impact investment funds, things like that.
Thank you very much, Xavier. And Colleen, I just found a list. I don't know if you've looked at it after Xavier mentioned it's Canadian government grants on ESG. You might want to have a look at that just in case. Hope that helps. And fellas, we are 1 minute over the line. Have we got time for Łukasz question, please? Tommy, Xavier?
I can stay for a couple of minutes, but I have to leave at about 5 past to head to another meeting.
I've only got a couple of minutes.
Okay, I'll be quick then.
Please, Buki.
All right. So my name is Buki. I'm a chartered accountant. I run a fractional CFO practice, but my question is related to my endeavor in fintech. So I've got a fintech product or service. It's like a software, like a plugin. It's going to be, the main aim is it'll help businesses make more profits. And I know that all businesses say this, that can help them make more profits. But my question is, how do I guard against? I'd love to give more of a background, but I can't because of time. So question is, how do I guard against my idea being stolen? So I'm not worried about giving away too much, because I know we can do that. We can watch over that by using lawyers and the legal system and knowing what percentage you want to give away.
I hear you. How do you keep people from stealing it?
From stealing your idea, just because if I need to present to them, I need to show them what this is going to do and how it's going to do it.
I hear you. I'll give you my quick 2 pence, then pass it on to the investors. The people that can steal your idea don't have the time, and the ones that have the time, they don't have the.
Okay.
Yeah, I think it's, people worry about this, but it's, less of a worry than probably you think it is. Most of the people you'll be presenting to will say, this is something, if it works, we'll pay for it to use it, but we're not necessarily interested in taking on the risk and spending the money and developing it and then having to market and sell it. If it can actually help them the way you say it does, they're probably just happy to pay for it and use it rather than go and build it themselves.
Okay, cool. Thank
Xavier?
you.
Yeah, I totally agree. I think it is a problem that exists in people's minds, but it's not as grave as you think. Effectively, you're just doing something that people need. Do it well. You are the person that is the driving force behind that. And then what a lot of entrepreneurs end up doing is being bought by these companies, because there's, as Anton said, they don't have the time to risk the money. You're the person risking your time and your efforts to go and bring this thing to life. They think, oh well, this is a problem that's being solved. There is a market here. That's great. Bucky's done it. Let's buy her business, and then that's usually how it works.
Okay, cool. Thank you.
Thank you very much. Thank you very much, gentlemen. I'll add something quickly as well, Buki, but I'll let Xavier and Tommy go.
Thanks, Anton. Thanks, everybody. Bye.
Thank you. Have a good one.
Thanks.
Cheers. Buki, just on these Q&As, I must have spoken to almost 2,000 founders in the last 3.5 years. And I can honestly say, I'm not sure I have ever met anyone that has actually got an idea for a business, because we all claim, and I've done this myself too, by the way, that, we're the only one doing this. And I can honestly say I have not met one that is doing or wants to do something that no one else has done or thought of before. The point I'm trying to make here is that ideas are great. It's nice to have good ideas and they can take you far. But when it comes down to it, it's mainly about one's ability to execute, whether it is to build it, to bring the team together, to go to market and all that stuff, which is why a lot of times that worry about people stealing ideas. I mean, don't get me wrong, that does happen. People do steal ideas, but it's the probability of that. It's so small. It's not worth worrying about.
Worried about.
That's my experience anyway.
Okay, cool. Thank you. Thanks for that input.
You're very welcome, and best of luck. Yes, colleague.
Thanks, Anton. I just want to say most people are too lazy to even steal the ideas. So,
Okay.
to be honest with you, they're too lazy. That's all I want to say. We'll try it. But.
All
There
right.
you go. Well, thank you very much for joining us today, everyone. This was Startup Fundraising Q&A. It's our 121st one. We do this every Thursday from 12 to 1 p.m. UK time, where we seek to help startups like yourselves with whatever questions you may have on fundraising in order to take your business to the next stage. We run 4 regular events per week: Monday's Talent, Tuesday's Product and Tech, Wednesday's Growth, and Thursday's Fundraising. They're all from 12 to 1 p.m. UK time, and you may RSVP to any of them via our website, startuptoscaleup.club. On the other hand, you can also perhaps share this or tag people that you know, or share this with people in the ecosystem. Hopefully, you'll be able to join us next Monday for Startup Talent Q&A. For now, as far as my parting words are concerned, just remember the startup journey can be quite exciting, but also quite challenging. So try to have some fun in the meantime and be kind to yourself and everyone else. Otherwise, huge thanks again, and God bless you all. Bye-bye for
Thanks,
now.
Anton. Really enjoy it. Thank you.
Thank you. Bye.
Thank you.
Bye.
Bye-bye.